Most people believe that when the Federal Reserve cuts interest rates, life gets cheaper almost immediately. They picture lower credit card bills, cheaper car loans, and mortgages they can finally afford. That belief is costing millions of Americans real money right now, and the banks are counting on you to keep believing it. Here's what actually happened. The Federal Reserve cut its benchmark interest rate 3 times in a row at the end of 2025, reducing it by a total of 0.75%, and bringing the federal funds rate down to a range of 3.5 to 3.75%. On paper, that sounds like good news. Politicians celebrated it. Financial headlines called it relief. News anchors repeated the phrase, "Rate cuts are here," as though the hard times were officially over. But for the average American carrying a credit card balance or trying to buy a home, the relief never came. And there's a very specific and deliberate reason why. The people who sit on the Federal Reserve's rate-setting committee cannot agree on what to do next. Their internal projections, known as the dot plot, reveal one of the most divided outlooks in recent memory. Some policymakers expect rates to fall all the way to 2 or 2.5% by the end of 2026. Others believe rates should stay exactly where they are. A few expect only minor adjustments somewhere in between. What that level of disagreement means in practical terms is that the Fed is functionally frozen, watching economic data and waiting while consumers continue paying elevated interest on everything from credit cards to auto loans to personal lines of credit. The committee that was supposed to bring relief is arguing among itself about whether relief should even happen. And that internal disagreement has a direct cost to you every single month. To understand why, you need to understand something that most personal finance content never explains clearly. The Federal Reserve does not set your credit card interest rate. It does not set your mortgage rate. It does not set your auto loan rate. What it sets is the federal funds rate, which is the rate at which banks lend money to each other overnight. Everything else, every interest rate you actually encounter in your daily financial life, is set by private financial institutions who use the federal funds rate as a reference point and then add their own margins that toss on top of it. Banks are under no legal obligation to pass Federal Reserve rate cuts onto borrowers in any particular time frame or at any particular percentage. History shows clearly and consistently that when the Fed raises rates, consumer borrowing costs go up almost immediately. When the Fed cuts rates, consumer borrowing costs come down slowly, partially, and often not at all if banks believe they can hold the line without losing customers. This asymmetry is not accidental. It is one of the most profitable structural features of the modern retail banking system, and it has been operating this way for decades without most consumers ever noticing. The average credit card interest rate in America is still sitting above 20% as of mid-2026. That number did not meaningfully move when the Fed cut rates 3 times in 2025. It did not drop by 0.75% to reflect what the Fed actually did. In many cases, it did not move at all. And it will not move dramatically for the remainder of 2026 either, because the Fed's own policymakers cannot commit to a clear direction, which gives banks every excuse to hold their rates exactly where they are while they wait for certainty that may never come. Now take a moment to think about what this means in real dollar terms, because this is where the trap becomes impossible to ignore. If you are carrying $5,000 in credit card debt at an interest rate of 21%, you are paying approximately $1,050 in interest every single year just to stand still. That is $87 every month leaving your account and going directly to the bank before you have paid down a single dollar of what you actually owe. If you are carrying $10,000, that number doubles to $174 per month. If you are one of the tens of millions of Americans carrying an average balance across multiple cards, the annual interest cost can easily exceed $2,000 or more. That is money that is not building your savings. That is money that is not going into investments. That is money that is not improving your life in any measurable way. It is simply the cost of waiting while you hope the Fed does something that will make your situation slightly less expensive. And here's the part that should genuinely alarm you. Many people who are carrying that debt made a conscious decision over the past year to slow down their payoff efforts because they heard that rate cuts were coming. They put extra cash into savings instead of attacking their debt. They figured that when rates dropped, the burden would ease and they could deal with it then. That decision, made with completely reasonable logic based on what financial media was telling them, cost those people hundreds or even thousands of dollars in unnecessary interest The trap is not that the Fed lied. The trap is that the connection between Fed policy and your actual financial life is far weaker and far slower than anyone tells you. And acting as though that connection is fast and automatic is genuinely expensive. Meanwhile, the mortgage market tells a nearly identical story. Rates on a 30-year fixed mortgage are sitting at 6.35% as of June 2026. That is not the emergency level of 7 or 8% that briefly appeared in 2023 and 2024, but it is also nowhere near the relief that millions of prospective homebuyers were told was coming. For a $300,000 home purchase with a 20% down payment, a 6.35% rate means a monthly principal and interest payment of approximately $1,490. At a 5% rate, that same payment drops to roughly $1,288. That is a difference of over $200 per month, or more than $2,400 per year. People who delayed buying a home because they were waiting for that lower rate have been paying rent during that entire waiting period, building zero equity, while the rate relief they were counting on has moved at a pace measured in fractions of a percent over many months. Home equity loan rates are averaging 7.86% right now. HELOC rates are sitting at 7.25%. These are not emergency numbers, but they are also not the affordable borrowing environment that rate cut headlines implied with arriving. The gap between the story and the reality is significant, and it is a gap that costs people money every single day. They make decisions based on the story rather than the reality. Here is what the people who avoided this trap did differently. They stopped trying to time the Federal Reserve and started making decisions based on current conditions rather than anticipated future conditions. That sounds simple, but it requires a genuine shift in how you think about personal finance. Financial media has a structural incentive to make Fed policy sound like the most important variable in your financial life. Because Fed policy is dramatic, it generates headlines. It gives anchors something to discuss, and it makes financial decisions feel like they should be postponed until the next announcement. None of that serves your actual financial interest. The people who made smart moves in this environment looked at the rates available to them today and acted on those rates. High-yield savings accounts are still offering returns well above the historical average, with some institutions offering 4% or better on liquid savings. That window will close when the Fed eventually cuts rates more aggressively and banks have cover to reduce what they pay depositors, which they will do far more quickly than they reduce what they charge borrowers. Certificates of deposit are still allowing consumers to lock in competitive rates for fixed terms, protecting returns against whatever that the Fed decides to do in the second half of 2026. These are not exotic financial instruments. They are basic tools that reward people who act on current reality instead of waiting for a future that may not arrive on schedule. Paying down high-interest debt in this environment is one of the highest returning financial moves available to anyone. Eliminating a 21% credit card balance is mathematically equivalent to earning a guaranteed 21% return on that money, which no savings account, no index fund, and no certificate of deposit can match. Every month that payoff is delayed, an expectation of rate relief is a month where that guaranteed return goes uncaptured. The action plan that emerges from all of this is not complicated, but it does require letting go of the idea that the Fed is managing your financial life on your behalf. List every debt you are carrying and its current interest rate. Stop waiting for those rates to drop and start attacking the highest rate balances with every dollar you can redirect toward them. At the same time, make your savings work at the best available rate right now, not the rate you hope will exist in 6 months. Review any upcoming major financial decisions, whether that is buying a home, refinancing an existing loan, or taking on new debt, and run those numbers based on rates that exist today, rather than rates that might exist if the Fed moves in a particular direction at a particular time. The Federal Reserve is managing the largest and most complex economy in the world. It is balancing inflation, employment, global capital flows, and political pressure simultaneously. Its decisions are not designed to optimize your household budget. They are designed to manage systemic risk at a national level. Treating Fed announcements as personal financial guidance is one of the most common and most costly mistakes that ordinary investors and consumers make. And it is a mistake that financial media actively encourages because uncertainty keeps people engaged and coming back for the next update. The Fed rate trap is not complicated once you see it clearly. It is the natural result of believing that a policy tool designed for the entire economy will automatically and quickly improve your individual financial situation. Closing that gap requires nothing more than making decisions based on what is actually true today, acting on current rates, eliminating current debt, and building current savings without waiting for conditions that may or may not materialize before the end of the year. That is the move. And the best time to make it is right now.